Hello, my name is Frankie Lesperance. In today's video, I am going to talk about the financial reports. What is financial reports? We will see the different types of financial reports. We will see the relationship to each other. We will see how they are different from each other. We will see the usefulness in helping managers make important decisions about business, and finally we will conclude. Let's get started. Hello again, this is me. As I said earlier, we are going to look at the financial report itself. What is a financial report? A financial report is a written document that describes the financial performance of a business for a specific period of time. This is very important. This for a specific period of time. We have three main categories of financial reports. We have the balance sheet, we have the income statement, and we have the statement of cash flow. These three categories of financial reports are different from each other, but at the same time, uh, they have their relationship. Let's look at the balance sheet. What is the balance sheet? Here we are, the balance sheet. The balance sheet, what is it? The balance sheet is a financial report that describes the owns and owes of a business for a specific period of time. This is what the business owns and what the business owes for a specific period of time. So the balance sheet here describes what the business has in its possession and what they has as debts for a specific period of time. So the people who are interested in the business will look at this specific financial report to know if they should invest in this business stock or not, the company stock or not. If you look at the balance sheet, you will see three specific parts. These three specific parts are the assets, the liabilities, and the owner's equity. So the balance sheet gives you an idea of the financial position or the financial situation of a business for a specific period of time. That's it. The income statement. What is the income statement? The income statement is the financial report that presents the revenues, the cost, and the expenses of a business for a specific period of time. And at the end, it will reveal if the business is profitable or loss making. I don't think anybody is interested in a business or in a company that is loss making. Instead, the investors are looking for businesses that are profitable, very profitable, that are healthy financially. That said, nobody will be encouraged to invest in a company that that is working on loss making. So it is very important. This part is very important for the investors because the profit will be used to share to the shareholders of the investors. So this part is very important for the investors. In the next slide, we will see the statement of cash flows. This statement of cash flow. What is the statement of cash flow? The statement of cash flow is a financial report that traces the amount of money that is flowing in and out of a business for a given period. This financial report has three parts. This is the cash flow from operations, cash flow from investing, and cash flow from financing. The cash flow statement measures how well a business generates money or cash to pay its debts, to fund its operating expenses, and to fund its investment. The cash flow or the cash flow statements is the complement of the balance sheet and the income statements. How can we explain the relationship between the data from the three financial reports? As I said in the prior slide, the cash flow statement is the complement of the balance sheet and the income statement. So every data from each statement is related to each other. For example, the cash from operation collects these following items: account payables, account receivables, and we know that these two items comes from the balance sheet. So that is where the relation comes from. When we look at the operations from financing, we notice that some cash can be used to pay the shareholders or the investors. And we know that dividends are parts of the income statements. So this allows us to say that the cash flow statements and the income statement are related to each other. So overall, the cash flow statements, the data from the cash flow statements and the data from the balance sheet and the income statements are related to each other. Compare and contrast the three reports in order to determine the related values as support tools for decision making. The balance sheet pictures what the business owns and owes for a period of time. The income statement reveals the amount of money that remains in a business after deducting all its expenses from its operating expenses, which will let us know if it is a profit or a loss. The statement of cash flows zooms the money that comes in and out of a business for a given period. All these data should be taken from the same period. You cannot take a data from the year 2000 to include it in a financial report of 2022. This would make no sense. All these data are valuable and will help business leaders to make the best decisions ever. Identify at least two different types of action that managers might take based on the data contained in each of the reports. Explain why these types of action should be based on the information in the respective reports. After analyzing the financial reports, managers can use the results to take multiple actions or to make important business decisions. Let us consider these two actions that managers can take based on the data in the financial report. For example, they can help them prepare budget, and also they can help them cut costs. To prepare budget, manager can use the information or the data in the financial report. These data can help managers take better actions. They will serve as reference, but not to include in the budget, considering the importance of historical data for future decision. Cutting costs. Um, when we consider that there are expenses that are unnecessary, uh, if we can consider a subscription that a business is paying, but that is no longer used, this cost is unnecessary. It should be cut off. So, both these actions should be based on the information in the respective reports because they are the key elements to help managers make better decisions for the future of the business. Overall, the balance sheet, the income statement, and the statement of cash flow constitute the financial photography of a business. Before investing in a business, any investor will make this first move of looking at its financial statements to see how is the financial health. Any company that presents a bad financial health or a bad financial performance will not interest investors because the main purpose of investing in a business is to have a good return on investment. So the managers have this huge responsibility to run the business properly, to make it interesting, to attract more investors possible. If they can do that, they will drive business success and expansion. Thank you for watching.